We're going to get started. Our first panel today is a little different than anything we've done before at Tactical Trading Investor Forums. We're going to be talking about ESG and tactical trading. So how do the two intertwine? I mean, we've heard a lot about environmental, green funds, sinless funds that, will trade equities, but don't trade tobacco, don't trade, the sin stocks, things like that. But how do we reconcile these goals, things like, doing social good, looking at governance, looking at environmental friendly investments when we're also talking about trading tactically? So we're going to be bringing on two experts in this field to join me on this first panel. So we've got Ranjan Bhaduri at Bodhi Research and Adam Phillips, who up until very recently was the head of ESG for the United Nations Pensions Fund. And Adam is going to be our discussion leader for this and really guide us through this topic today. And Adam, why don't you take it away?
Yeah, thank you so much. I appreciate it, James, and it's a pleasure to be here. And I think it's a unique time for ESG, obviously, because here we're talking about ESG in the context of futures trading and managed futures, and the construct of how it applies within that sphere of influence. And today we're gonna talk about many different aspects around that and give you an overview. I think it's helpful to start with an overview of what ESG is and the asset classes that pervade them. Specifically, how it's constructed within the context of equity, fixed income, and alternatives, and how does ESG apply differently within each one of those verticals, and particularly within the industries within each of those asset classes, and then most importantly, how securities are selected. Then going into the different types of methods that these scores and ESG data is used, particularly from a fast-moving perspective for the futures market, and the slow-moving perspective in the standard markets that you see in traditional portfolios, which establish trends for futures traders. And then stepping into, obviously, the different methods from ESG screening to custom values-based approach, capturing ESG momentum, and the thematic-driven investments. The summary of all of these areas is that the inherent ESG risk premium is here to stay for many, many reasons associated with risk. So I'll start off with David. David, would you want to discuss all the different types of how financial materiality is applied to the different types of the ESG products within each asset class?
And apologies, David is our major domo for the entire conference, so he shows up behind the screen but is not actually on the panel. But Ranjan, can you take that one?
Yeah, I fair enough. I thought as much. And thank you, James, for this invitation. Thank you, Adam. Really, I'm very delighted to be on the same panel as both of you. And I thank most of all the audience. I'm actually gonna take it a step back from what Adam, if you don't mind, from what you just stated, which I think was, very articulate and fluent. But I just want to, what I want the audience to sort of recognize is that in some ways, ESG is everything, right? Like when you're talking about the environment, the earth, I mean, you could even be talking about the solar system and space. You're talking about, the S in social, and then the governance. In reality, that's everything. And if you want the intuitive reason why ESG works, well, doing the right thing over the long run pays off. If you think about 20 years ago, Enron and Arthur Andersen weren't doing the right things, and where are they today, right? Meanwhile, IBM's been around for 120 years. I'm not saying IBM's perfect, but obviously they have, they wouldn't be in business today if they didn't take, make a lot of correct decisions with regards to how to treat employees, how to reward employees, how to think about research and investing in research and so forth. And so one thing that I really state is that, you want to be looking at it as not as though this is brand new, but this is something that every business has some elements of ESG and some components of ESG. You can't avoid it. How do you do hiring? What's your hiring policy, right? How do you compensate your employees, right? Like all of these things, it dovetails very much with business, and so futures trading has some inherent advantages, and I'll talk about that a little bit later on. But I don't want to, like, this is something. And Adam, you got to keep me reined in, because this is something I want to make sure James gets his fair share of airtime, right? So I don't just wind up on the soapbox.
Yeah, I talk enough. Don't worry about me, bud. You go.
So it's, but I will explain a little bit about what I mean by futures has some inherent trade advantages in a short while. But Adam, back to you maybe.
Yeah, and before we start here, it's really important to differentiate between two aspects of ESG. One is impact. This is driven by a purpose to achieve an outcome, which doesn't necessarily mean a particular fiduciary duty in terms of trying to get the optimal return. In the context of what you're seeing, this big evolution in the markets today, the circular economy perspective, monitoring all aspects of stakeholders, is how do we maximize our return in relative to the ESG impacts within each asset class, within each industry, within each security. And the key and the most fundamental perspective that I think all the clients here today need to leave with is that the importance of financial materiality to proofing the construction of those products. As long as financial materiality, i.e. the ESG components that are assessed in these instruments are related to the financial material outcomes over the longer period that Rajan's talking about, and there is substantial amount of white papers published across the world to support that ESG-driven portfolios over the longer run tend to outperform because they capture societal trend changes. Okay, so as long as that approach is taken, you tend to get inherent behavioral aspects to ESG, i.e. you tend to see quality, you see less downside risk capture, you see min-vol characteristics, and that quality orientation. And this is because when you take that approach, that's an evident outcome. Now that ESG analysis is backward looking. Moving into the futures area where we see an immense amount of growth in ESG is driven because last year alone, the human civilization downloaded more information than the entire history of our civilization. And that means something. And what also is happening is our ability to infer from that and creating what are called fast-moving variables, i.e. NLP. We're able to scrape the web, capture it, and bring it in and regress it, whether it's parametric or non-parametric, and assess what is the momentum of news and how it's impacting the changes or preference, the economic preferences, the investment preferences of investors, which is crucial for futures traders, right? So what are the long-term trends, but what are the short-term reversals that I need to focus on from those fast-moving ESG variables? And we can go into that. Rajan, you want to talk about how quants reconcile these ESG goals, whether it's from an NLP perspective, and we can talk about the larger preferential views towards specific trends in economics and investments, and then we can start talking about how to properly construct those ESG funds from a statistical perspective.
Adam, you're gonna find out that I'm like it's sort of going back to school where I was like always very out, I don't only think outside the box, I rip the box apart. So,
Yeah.
so you're going to find that sometimes I'm just going to go in some different directions, but I promise you everything is going to be very ESG related. But I will maybe start with answering, trying to answer your question and stating that in the equity space, you're seeing like a lot of ESG quants. And what's happened there is that what is somewhat ambitious is trying to take, every company, every publicly listed company or publicly traded company, and to try to give it some kind of ESG score. And there's different organizations, that are, it's a very daunting task. But there are different organizations that have, different ESG scoring. And then there's certain hedge funds that will create their own internal proprietary ESG scoring, where maybe they're using some of these external data sources, but then they're massaging it with some, some overlays. And this is all like, it is very challenging because, you alluded to it when you spoke about the news. Things can change instantaneously, and that doesn't necessarily get captured into an algorithm. So when you're doing something in a systematic fashion, how do you know that, okay, this piece of news has happened? And that's, that's where I think some of the biggest challenges are, is on the data quality, the fragmentation, and the actual like methodologies. And this is where, from the investor's perspective, the institutional investors and family offices, you really need to go and do a deep dive due diligence. I'll give one recent example where there was this quantitative hedge fund that was doing their own proprietary kind of ESG scoring. And, it's a well-established multi-billion, good people and so forth, good track record. But, you got to keep it real when you do this ESG. Like, if you're, at the end of the day, I bring it back to, ESG, what excites me about it is that in some ways it's challenging businesses and the world to make the world a better place, right? For future generations and so forth. And in the day-to-day, with all the business challenges and problem solving and so forth, that vision can sometimes be lost. And I urge each and every one of you not to lose that vision, because if you don't have that vision, ultimately it'll be disingenuous and there will be more gaps in what you do. And for this particular hedge fund, they were using KPMG as their auditor for their fund. Now, KPMG is a top four, big four auditor, not top four, big four name and so forth. But I asked them, well, did you challenge KPMG at all for what they did in 2019? I mean, they were listed as one of the biggest scandals in 2019 and they got fined, I think it was $50 million by the SEC. They literally cheated on integrity tests, and also paid for stolen information that would help them under SEC audits. So like they did two very, very horrible things that they paid a fine for in 2019. It went through, the proper process and due process. And I mean, that's deplorable. But I'm not saying don't use KPMG. I'm not saying that everybody at KPMG is bad. I'm sure the people who were doing the audit for that fund were good people and they did it correctly. But there's something wrong if an ESG fund doesn't sit down with KPMG, their auditor, and say, you guys were in the news for all the wrong reasons. We're an ESG fund. You have a total lack of governance, total lack of leadership here. And we're paying a premium because you're a big four, presumably because you're governance. How is this never going to happen again? What have you done to rectify it? You got to at least have a sit down meeting and then to be able to tell your clients that you've done that. And that's what I mean with regards to, not just, that's what I mean with keeping it real, right? You have to look at your ecosystem, your immediate ecosystem. There's a lot of things we can't control, but you're the one selecting your auditor. And if your auditor is not doing things in a right way, you really, if you're just letting them get a free pass, that doesn't show that you really care necessarily enough about the G in ESG, right? That brings the question, how good are your algorithms and so forth, right? Like, so I mean, the PM was sort of pissed at me, right? Like, because he was expecting a lot of investment, quantitative questions, and I could have gone that way, but this was an immediate, to me, this was an immediate turnoff.
Yeah, I think that the financial industry as a whole, we've got to do a better job of holding people accountable for failures of governance. I mean, it's really, our industry gives people second, third, fourth chances, and they do really bad things and get a pass as long as people think they can make money, or as long as they could be effective in sleazy sales. And, it makes me sick. I mean, I'm someone who's done about 3,500 hours of pro bono legal work, for the industry, cleaning up, frauds at MF Global and PFG pro bono. And to see, for example, Henry Steenkamp, who is the CFO at MF Global, who created the break the glass plan to use customer liquidity to fund MF Global operations and, gross violation of CFC rules, to see him still employed in the industry is disgusting. I mean, we've seen it, really across every aspect of banking, hedge funds, finance. And, at the end of the day, investors have to sincerely prioritize, trusting their money and trusting their clients' money to people who act like fiduciaries and actually care and have ethics. And, until you see that effect and, say, hey, if my auditor is, committing fraud, maybe I shouldn't be using them. I'm hopeful that the ESG concept will help push people to just in their day-to-day businesses hold their service providers and their principals accountable. Because also at the end of the day, it's not companies that commit fraud. It's not companies who break the law. It's people. Like, some individual somewhere has to make the decision. I'm going to break the law. I'm going to do something unethical. And it trickles down to the company if they don't have proper controls in place, governance in place, DOJ to actually bring criminal prosecutions. Like, there's many legs to that test, but when the marketplace has a lot of power to hold accountability, and we've really just seen kind of the tip of the iceberg there.
Yeah,
and I got to just echo. I mean, I also will say that this is one of the reasons I have immense respect for James, and so does so many people in our industry, is that, like, he really is a champion for good. I mean, what he did with regards to MF Global, that is something that should never be forgotten. And MF Global is yet another example. Like, if you do the wrong things, it doesn't pay off over the long run, right? Like, but yeah, that is like I think I've answered your question to start with, at least part of it, with regards to, some of the quants. One of my piece of advice to the audience, those that are managers, is, keeping it real and looking at it, like, probably more so than any other strategy, when you are doing something systematic, when you create systematic trading models, there's a certain amount of, you got to try to really keep it honest, and you're always questioning yourself. Okay, am I overfitting? Am I, I'm not doing too much back testing and so forth. It's what Richard Feynman, the late physicist, stated. The easiest person to fool is yourself. And so in creating these kind of systematic quantitative models, you can't fool yourself, and you got to be, you really can't be taking the shortcuts, and you really got to be asking yourself the tough questions. Now, this you know, this is something that all the successful trading managers, those that are successful on the quant side over the long run, they've all have a very good ethics in terms of from a scientific integrity perspective, right? And now this is something that needs to be translated where you're writing certain things down in terms of your ESG policy. And I don't care if you're now, I think that every CTA, every trading firm should start thinking about for 2021, just like they have a compliance manual, they have an ESG, this is our ESG principles, right? And I think that is something that will resonate with institutional investors. And it doesn't mean it's something that's one and done. It's something where this is what it is in, February of 2021. Maybe we're going to update something in, 2 quarters from now, but it's something that is a living, document, and it forces you to think about it. And it goes back to every single component. Again, like everybody talks about diversity and how it improves. How are you measuring diversity, right? How are you ensuring, okay, diversity is a good thing. How are you implementing that? How are you fighting against behavioral biases that might be even subconscious, right? And so forth. So these are all things that are very difficult. Like nothing is easy, and but it requires a lot of thought and effort and energy.
Yeah, and from my experience and helping to evolve and develop ESG 1.0, I would say this: ESG is the first. It is really the first silo within investment management, other than technology, to really break the silos across an investment organization. Why? Because ESG touches not only, as Rajan pointed out, the internal and external stakeholders of your organization and who you invest in, but also the regulatory, the governance, the legal issues, the investment aspects, and unifies it in an all-encompassing sediment metric. And those metrics over time can really unearth specific trends, but also from a sediment forward-looking perspective, particularly as a futures trader and managed futures, to see what reversals and sediments can be captured in so doing. And looking at both of those to help recalibrate, and as Rajan said, understanding our perspective of whether what we see is actually really what's going on. And those two metrics help to buoy that. Shifting over, Rajan, like COVID-19 is obviously revolutionary for our generation, the multiple generations that are going through this now. But inherently, ESG funds have done better during COVID. And what is your perspective on why you think that ESG-driven strategies, whether quantitative or fundamental or impact-driven, are doing better during COVID-19?
Yeah, that's a very difficult question, because in all sincerity, like, and I'm a big believer in ESG, and I'm very excited about the the amount of demand and attention and resources and energy that's going towards ESG, but I'm not yet a big believer in that. In terms of the definitions and in terms of the consistency. I've talked about, how things are definitions, a lot of groups, it's very fragmented, and sometimes the data might not be as clean as possible and so forth. So part of me, this is not a very deep answer, but part of me wonders whether that just might be, like if you were just to randomly take a collection of managers and label it as, okay, this is, whatever, like this is a certain set, and that set has outperformed the rest of the universe, it might have just been, some element of randomness. Now, I don't want that to imply that I don't believe in ESG, because I think that everything about ESG is really translates to better business, better returns, better processes. And so if it's being done correctly, yes, it should outperform, right?
Yeah, yeah. And one of the areas that we see, and this is really important, I think, for the audience to understand, ESG is not a cure-all. It explains maybe 2 to 5% of residual alpha, 2 to 5%. But why is that important? Well, it's getting harder and harder to outperform on a relative basis, right? But that 2 to 5% of that marginal impact on a futures position or absolute return is quite substantial. And the impetus of putting in financial materiality to increase the robustness of what you're analyzing is crucial. And I think one of the tidbits that we've learned over several years is the S&P, for example, in a futures position. If you look at the S&P companies, break them apart, 80% of S&P companies are 80% of its market share is based on intangible assets, right? And so what statistically has the greatest impact to intangible assets of a company in the United States, S&P 500, is social, believe it or not. Not environmental, not governance, but social. Why? Because the changes in social norms, i.e. Facebook, Twitter, and all these issues that came out of COVID impacted the valuations of these companies. Privacy, election monitoring, and all these areas impacted the monthly active users and the financial material impact to those users, and that affected the pricing and volatility of those positions. So as social norms change, the transitory impact to intangibles within S&P 500 are quite substantial. And the S&P 500 is 8% intangibles. So the key here, I think the takeaway, and continuing with what Razan is saying, is understanding what the material impact to those industries are and how it's encapsulated into the financial performance of a company is absolutely crucial and can further enhance your understanding in a futures, managed futures position. Shifting over, this is a very popular topic. I chair the CFA Society in New York, and we had a whole event on this, on the U.S. Department of Labor's decision to eliminate socially responsible investing within the context of retirement funds, and also some of the SEC's decisions and potential legislation. Going forward, we have a new shift. We're going to have a new administration taking over, the Biden administration. We've seen interesting nominations, in particular the nomination of BlackRock's head of sustainability as the Economic National Counsel, and Brian Deese, who comes with a sustainable investing background. So how will that impact going forward the Biden administration in conducting ESG within the context of Department of Labor application to retirement funds, and also the SEC and how they view ESG materiality as a critical function in managing retirement funds, Rajan?
Well, I mean, I think that's a lot, and not to ask. First, I'll state I'm neither Republican nor Democratic. I'm Canadian, right? So my answer is going to be I don't want to give any political kind of views, but it's I will state that it's all connected again, right?
Yeah.
Like in terms of everything that's happening there is all it affects the way that the regulators are looking at things, the scrutiny, the priorities. I mean, all of this comes from the different policies. But I think that bringing it back to our audience, right? Like it's really, in some ways I would say CTAs have a big advantage, right? And the big advantage is that, and I remember maybe this was like going back like, 7 or at least 6-7 years ago, I spoke at the University of Ottawa. I gave a seminar at the Department of international development and political science about hedge funds. And it was a very, the audience was a small audience, and they were very, I would say that they were very skeptical of Wall Street and hedge funds and so forth. They sort of had their minds made up that this is all very negative. And I said, I just said, well, look, we're not creating any pollution. If we're systematically trading futures, it doesn't create any harm in terms of for the environment. It's environmentally friendly, right? When you're building something, you're building whatever it might be. When you're building a chair or a desk, and when you're building something much more like industrial, there can be pollution, there can be certain natural resources that are being utilized and so forth. So there is an inherent advantage for trading strategies. I had had the privilege of living, working, and studying in the state of Hawaii many years ago, and I will state that it's one of the most beautiful places on the planet.
Yep.
And I've always wanted Hawaii to become like a financial center because it's good for the environment and so forth. So we have that advantage in the trading community already. Now it's a matter of putting everything else around it in terms of the policies. And I think there was a question from the audience that I noticed in the chat asking about ESG hygiene, right? And really, so the question is, how do you get comfort that a manager has ESG hygiene and hygiene in general? I think that is very similar to the rest of the due diligence, right? Like in terms of really understanding the culture and the processes of the manager, and whether something's just written in a book, but are they really implementing those processes, right? So now your question, Adam, was a deeper question, and there's a lot of ramifications there, and quite honestly, I don't think I'm the best suited to answer.
Yeah, thank you. I appreciate it. And shifting over to James, James, this is your area. It's something that it is close to your heart, and you have driven a large part of the genesis of this question. And I think it's important to get your opinion on how the DOL and SEC will approach this topic, and what will be the impact of the fund industry, the managed industry on these shifts and changes, and what your perspective is, being that you've done such a great job in the MF Global recapture, and so your experience brings such a richness to this meeting. Can you get your perspective on this issue?
Yeah, I think the DOL thought process is a really important one. And intellectually, like early ESG funds, I always thought didn't belong classified as investments, right? A lot of them completely decoupled performance from the stated goals, be them environmental or social or governance, right? And that's why me at Typhon, I'm like, okay, well, I want to do, I can't just be a hedge fund manager whose whole goal in life is to make rich people a little bit richer, right? I got to do something else. And, pro bono wise, I'm like, okay, I'm going to go do MF Global. I'm going to do PFG. I'm going to work with Congress. I'm a federal whistleblower. All that I've done completely pro bono because I viewed that as being separate, from Typhon's core mission, which is, to make money for investors in an uncorrelated fashion, right? My thought on that has evolved, right? So taking, what Ranjan says, futures trading, it reminds me of the medical oath, which is first do no harm, right? And future strategies on their face don't do harm, right? Especially if you're not taking, physical delivery of commodities, you're actually, by trading futures, you're providing liquidity for producers and users of commodity. You're making those markets tighter. You're giving the, farmers the ability to hedge off their risk, right? Which, I think that's a great thing. And, by trading that as a speculator, you're facilitating the functioning of agriculture markets, of energy markets and whatnot, right? But, this has evolved, and I've kind of reconciled my kind of two personas, as one is, pro bono crusader who goes after the bad guys, and, futures manager over here. And, we've had a lot of feedback from our investors, and they've asked us to create a fund where we combine the two, right? So, right now on top of running Typhon, and, we've had a fantastic year on the futures business and performing well in stress periods, especially in March, which was our best month ever, right? But, combining things like the fact that I'm lead counsel in the Block 1 crypto securities fraud case, which is the biggest crypto fraud case of all time. Well, why don't we have a fund where investors can have access to the do no harm future strategies where they get uncorrelated returns, but be able to participate in litigation, like Block 1, where you are helping us to clean up the crypto industry. And, crypto, I think, is an industry that definitely needs to be cleaned up, but make uncorrelated returns at the same time. So Typhon, we've just, closing point, we've started to look at ESG and that governance and that litigation component as an actual alpha source. So if you talk to the DOL, where are cases where you have the most alpha? Things like MF Global, things like PFG, things like Block 1, where you're helping fraud victims, but generating returns, for investors at the same time.
Yeah, and so James, if we see this strong counter policy mechanism pervade with the changes in DC and NGOs, the legal counter volley that we're going to see, particularly from all the different NGOs that support ESG, and ultimate reversal of these policies. And the big elephant in the room for energy traders is the green economy shift. And the regulation and position that is going to take place across the entire globe, because this is the first time in history where not only that Asia, Europe, and North America are consistent in terms of leadership for a shift to the green economy. All the regulatory shifts and changes that are happening, not only in the DOL, not only in the SEC, that creates a right environment to launch a litigation strategy that centers on ESG efficiency and goals, no?
Yeah, absolutely. And it's almost like you're reading ahead, looking at the next panel, 9 minutes to go, but the next group is going to talk about, energy implications and the green economy.
And
well.
I'll just state that, like, I think that one of the ramifications is going to be more, through the passage of time, is going to be more futures contracts that are related to ESG, right? So
carbon trading and the carbon markets, cap and trade, they're going to become the new norm.
Yes.
Potentially.
Yeah, exactly. So, yeah, I mean, there's a lot of different kinds of contracts that can come through the passage of time that are ESG related. So especially as the data also, a lot of groups are doing a lot of good work with regards to trying to come up with ways to solve the data issues.
Yeah, absolutely. And we've got a question from the audience. They're anonymous, which I don't like, but it's a good question. So we're going to answer it anyway. What do you think of European pensions that purposely avoid trading agricultural products to avoid the negative impact this could have on the price of basic food items, driving prices up or down through speculation that could have a devastating impact on the poorest of the poor in our world? And I'm going to start with the answer on that. I touched on it earlier. I think that this policy shows that they don't understand the way that futures markets work, okay? If the policy said we avoid people who take delivery of agricultural products and hoard them to try to increase the price of food, I'd be all for it, okay? And then, perhaps if there's any European pensions listening at home, I would suggest you modify your policy to limit it to physical prices. But like I said earlier, when you are trading a future and you are not taking delivery, you are making the market more efficient. You are enabling those producers to hedge their risk, which is actually generally going to lower food prices by giving those producers a more efficient hedge market. So I am completely against driving up food prices for poor people, but I am emphatic that trading agricultural futures does not do that and actually does the opposite. But Adam or Ranjan, any more thoughts on that?
Yeah, I mean, you're 100% right. Like, it's actually, baffling that somebody would think that trading agricultural futures is going to increase food prices. It's actually sort of very scary to think about how expensive food prices would be and all the catastrophes that would occur if these kinds of futures contracts did not exist, and were not being traded. So, and this is one of the problems that happens sometimes with ESG, especially on the E part, is that sometimes there's, one can think they're doing something good, and there's second order, third order impacts when they're really not doing something good. And so one has to be very, very careful about that from a scientific perspective as well.
Yeah, I'd say the externality impacts, right? Implicit and explicit. I think give you a really good example. Coal has been substituted out largely. But in the largest population centers of the world, in India and China, it's a significant driver of energy. And the use of that coal is mainly for the poor of that country. And if you shut down thermal coal plants, particularly in those specific areas, you drive up the cost of energy for the poor. So what India and China are doing is investing heavily in green technologies as fast as possible. And I think as long as the incentive is there to change, this drawdown and using the best of breed technology to scrub these thermal coal plants and having a plan to draw it down over time, even though they've launched 20 new thermal coal plants, if it's buoyed by some sort of mechanism to, in the longer term, to balance that out, we have to let the markets efficiently transition that risk. We often view everything in black and white, 1 and 0. It has to be done now. No, that's not how the system works. It works over time. And in this case, in agriculture, yes, topsoil erosion is an issue. So what's being done on that part to counter that issue, and then also functioning of the futures market? So everything has to be seen in a relative sense of how do we push the larger initiative forward and not specific issues that can have external consequences to larger, more pertinent issues that drive voting, legislation, and et cetera, et cetera. I think there's another question here. This one's for you, Rajan. I think it's right down your wheelhouse. And this one's talking about thematic ESG investing versus, and how do we label them? Would you consider a fund to be, in a broad sense, an ESG educational programs, especially in the areas of mathematics and physics, which the anonymous person asked, slightly underrepresented in the current curriculum?
Yeah, no, I wouldn't consider the fund itself, like, if it depends what's being done and what the purpose is of the fund or of the organization. If an organization is choosing to make certain donations to, academic research, or, helping educate disadvantaged youth and so forth, that's a very, very, very good. But that doesn't necessarily mean the trading strategy is ESG, right? And so forth. So
yeah, and
that would maybe dovetail into the overall ESG culture of the firm.
Yeah, and values trading. Trading or building portfolios based on value has consequences. James, you want to talk about some of the work that AQR has done and a lot of in the hedge fund community about inherent premiums and potential dislocations and valuations that can be arbitraged, because there is an element of this. Let's just all be fair. You can approach it with an ESG financial materiality lens, but there is a group that trade based upon values, and they're seeking that impact over their financial returns, and how that flows into the futures market.
Yeah, I mean, I know Cliff. I haven't dug super, deep into that. I think conceptually, it's great. I mean, anytime you could quantify something, that's wonderful, but I haven't dug, deep into his specific research on it. But Adam, unfortunately, I think we're about out of time, and we got to start bringing on the next panel so we can be prompt at 10:10 for our Swiss friends who like us to stay on task. But Adam, Ranjan, known you guys for forever. I really appreciate you joining us for this. This is an awesome panel. It's pretty rare I get to learn stuff, on a panel that I'm actually on. But this is one of those times. So I really appreciate you taking the time out. And Adam, piano Christmas tree. What a background flex. Okay, that's a good background flex. ESG does pay, everybody.
Yeah, and anybody, any of the Typhon clients and anybody in the audience, feel free to reach out to me if you have any questions. Happy to answer them, whether it's on ESG metrics or and the confusion there and impact and return. And Rajan, would you like to close out?
Well, I just want to thank yourself, Adam, and thank James, and thank the audience, and enjoy this conference. And hopefully we'll be back doing it in live, in person. I mean, here in Toronto, it's just a snowy day, completely snowing right now. So thank you, everybody.
Thank you, everybody.
Thanks, Ron.